Are the markets starting to underprice the Fed for 2019 now?
Well, I think the markets are becoming a little bit more sanguine about the prospect of further rate hikes. As you mentioned, the rate hike now in December is only 80% priced, and we have about 2.25 rate hikes through all of 2019, which is quite a bit less than we had, a week ago. A lot of that.
I was referring to euro-dollar futures, which
I
think are even less than 2. Yeah, sorry, go ahead.
Yeah, exactly. But I think a lot of what's going on here is the volatility in the equity markets, and again, in the spread markets that we discussed earlier, filters through to Treasuries. So we've had about a 20 basis point rally in 5-year Treasuries over the last couple of weeks, which is really obviously takes out the probability of Fed rate hikes. I think the Fed is looking at a few things. One is obviously the global economic growth picture, the U.S. economic picture, and recall that the fiscal spending, the stimulus from fiscal spending that was introduced with the Trump administration, that's going to start to fade out of the numbers. So there is an anticipation that we're going to see slowing economic growth. And then there also has been some weakness in the U.S. housing market, right? We've seen that in a number of different indicators. And so in our mind, we were expecting some of the tightening to come out of the Fed over the last, for the next year. And that really, in some respects, has already come out. So I think we're going to need to see the Fed be more sanguine themselves about the prospect to justify current yield levels.
Right.
And so I would say the market is much closer to fairly priced than it has been. But I think that the debate rages on here whether we need to continue to tighten financial conditions or whether they've already tightened.
Right. I want to show a chart, which is your chart of the week. We've made a version of it here where basically you're tracking the current neutral rate, the long-term neutral rate, and then the Fed policy rate. And what we can clearly see is the current neutral rate is above the long term. During the financial crisis, it dropped below, and that, of course, had an impact on Fed policy. Now, what I want to ask is, we were talking about widening credit spreads, the last block. How much more credit market stress would we have to see to start to see companies deleveraging, the neutral rate drops below the long term, and then the Fed really has to rethink?
I think it's a very, very good question. There's a lot of questions that we debate internally within the organization will the Fed acknowledge the volatility that we've seen in the stock market and in spread markets? And generally, we look at the fundamental picture that the Fed looks at, and the economy in the U.S. is still very strong. Obviously, the employment picture remains very robust. And so in our mind, the hurdle for the Fed to acknowledge the widening or the volatility that we've seen in spread markets is still very high and unlikely to something we're going to get, particularly for the meeting coming up in December. But I think what more important is that in your chart, as the long-term neutral rate becomes more consistent with where rates are currently, then the Fed is going to become more reflective about the amount of policy tightening that they need going forward.
Yes.
The markets are very, very keen on that. I think it's very important to come back to what we were talking about in spread markets earlier. If you get any indication that the Fed is concerned about the volatility in spreads or is thinking about potentially pausing monetary policy tightening, you could see a very, very quick correction in the widening that we've seen, particularly in markets that have widened a lot. So emerging markets would be a good example. Right.
And given what we've been saying about the Fed as well, when we've talked before, Scott, you've always talked about being positive on the short end of the US curve if we look at sovereigns now, but you're getting a little bit more positive on the longer end in your latest outlook.
Yeah, and I think, in general, as the market becomes more fairly valued in the front end, the relative attractiveness of playing for kind of less monetary policy tightening becomes less attractive for us. So we like slightly longer maturities. And again, as I mentioned, credit spreads have widened quite dramatically. And so the combination of yield levels that are offered on Treasuries plus that incremental spread starts to look attractive.
Are the markets at risk of reading too much into what Jay Powell and Rich Clarida say next week if they're looking, importantly, at the fundamentals?
No, I mean, I think, the market is going to key, again, on any acknowledgement that the recent volatility in asset prices in the U.S. is impacting the way that the Fed is thinking. But in our mind, really, as they've said before, they're going to key on global economic growth. They're going to acknowledge the slowdown from the ending of fiscal spending. And so I think it's going to be a relatively balanced statement.